Hello, my name is Savannah, and this is my project for Finance 695 dealing with strategic investments. The strategy I decided to use was ROE with economic value added as a consideration to determine which companies to invest in. The theory behind this is a high ROE means that investors are getting back a higher return. However, I didn't want to just use one variable for this. I wanted something that would help to show if the stock was overvalued to a point that if it were to drop, there would be a lot of money lost, but also to prevent it from being so low that it's not worth anything. So, hey, with a combined ROE that's high and a solid EVA, we should be good to go. Some definitions: ROE, net income divided by shareholders' equity. ROE is useful for comparing the profitability at a company to that of other firms in the same industry. ROE is also much more driven by leverage, and it's what we make our shareholders. Economic value added is NOPAT, which is what we make, minus capital charge, which is what we want to make. So we look at whether it was paid above and beyond what it's worth or should be getting. I then gathered my data. I used 11 companies from the ones that we chose in class and went 3 years back, so I had 2013, 2012, and 2011, and got both the WACC economic value added as well as the ROE so I can compare it to the stocks of each year. I decided to run multiple variable regression tests for each year first and then combine all of the years at the end. For 2013, running this test, our p-value for WACC economic value added wasn't quite significant enough to show a strong correlation. It was very close though, with 0.08 compared to what we need, which is 0.05. However, ROE did show a strong correlation, being that it was 0.002. Again, you really can't just use ROE as a sound state of investing, but it does show a correlation, and that's what we're looking for. For 2012, we had no such correlation for the WACC economic value added, and we still had a very strong correlation for ROE at 0.003. For 2011, we did not have any type of correlation for WACC economic value added, but we did not have any type of correlation for ROE. When we take all the years and combine them, again, we did not have a significant amount of correlation for WACC economic value added, but we did have a significant correlation for ROE among all the years, or the 3 years, for the companies, which were 11 companies. So in conclusion, there could be a solid theory here, but we need to do more testing and perform it in industry rather than across industries. As defined before, ROE is useful for comparing the profitability of a company to that of other firms in the same industry. Here we're comparing across firms, so we need to narrow this down and use specific industries and then kind of compare to the outside instead of doing it across. There isn't one golden way to do this using one type of variable. There are many factors that must be assessed to make the more appropriate decision. So just using ROE or ROE and EVA isn't really going to determine if you should invest in a certain stock. You need to look at all the different values and maybe use ROE as a chance to put it above others, but never use it alone. Thank you.